All right. As always, we've got Dr. John Osborn, CFP, PhD, ChFC, 97
You're
alphabet.
not going to remember them all.
But if you want to know, you can Google them and you'll figure it all out, right? So John is here on our, we'll call it our annual update because we do this kind of once a year, right around this time, right? And if I recall, last year we said 12 or better, mild, moderate year. We were a little under, right? Got to 17 and change, I believe.
Got a little bit of a Christmas rally there.
Yes, yes. So it worked out okay. So I always like to start off with where are we going this year? What are your thought processes on this one?
Well, from the 10,000 foot level, all things being equal, which they never are, we look for a year quite a bit different but similar from last year. We do think the U.S. economy is probably going to do right around the same thing from an earnings point of view. So we think corporate earnings are probably going to be growing at a 14% level this year.
Right.
And that could surprise us on the upside. FYI, excuse me, I'm going to nerd out here for a minute, but the GDP in the second quarter was 3.8%, which was a lot higher than everybody thought.
Right.
And then the third quarter came in, it was 4.4. And, a lot of people were saying, oh, I can't sustain that. That's, blah, 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 given the reasons. And the Atlanta Fed does a kind of a indication of what it's going to be for the fourth quarter. And it's probably going to come in at 5.4.
Wow.
5.1, 5.4. It's probably going to be something with a 5 on it. So that's going to surprise people a lot too. This economy is a lot stronger than people think it is. And we also think on the same thing, as I'll just carry on the same vein here, that inflation's probably going to be going down to the 2.1, 2.2 range this year. So you're going to have you're going to be at the Fed's 2%. I mean, give or take.
Right.
And a lot of that is because productivity's picking up an awful lot. As productivity picks up, you have more goods, you have more services. If you look at the definition of inflation, too many goods chasing too few services.
Right.
Well, what do you have if you have too many goods, too many dollars chasing too many goods? then you've got growth, but you've got a lot of stuff, and the prices will then eventually come down. Yeah. So, the fair comment. So, if you're looking at the environment where you're producing a lot of stuff, your production levels are going up. We have less employees and more productivity. Okay, so the average wages are going up for people talk about inflation, you can't find jobs and everything, but productivity keeps going up with less people. That's part of the definition. And also the inflation adjusted wages go up. And so the people are making more money. That's a good definition of a successful market. The price is coming down, productivity going up. I don't want to stand in front of this thing and say, oh, no, the market's going to go down. I want to sell stuff. This is probably going to continue for the next couple of years, all things being equal. But as we're like politicians, we have to say that. But it looks like a very productive growth market. Don't be surprised if you see a melt up versus a meltdown this year. I don't really want to melt up. I think we're actually a little bit on the high side right now. But we can talk about that in a minute too on the bullish bears thing.
Yeah.
I'll exhale now.
Honestly, I don't really have a huge commentary. I mean, I think where we're at right now, interest rates are pretty stable. They're probably not going to tweak very much from here.
That's a good point. And that's why I said things, there'll be other things besides U.S. economy. But if you're looking at the U.S. economy, we really like financials right now.
Right.
Because the yield curve is getting steeper. So the short end is going down and the long is not going down. So the 10-year bonds are probably going to, excuse me if I'm getting weird here or anything, but
short, probably going to say, when he says short 1 to 3, when he says long 10 plus.
Yeah, 10 plus years. So it's getting to look like a classic yield curve. So the more farther you go out, the more interest you want to earn on your investment. It hasn't been like that for the last 3-4 years.
No, it hasn't. And lots of uncertainty. And when you remove uncertainty, people make quicker decisions, yes. Right?
And
Businesses,
companies can plan.
businesses make quicker decisions, right?
Right. On a stable environment, that's an excellent point. Stable environment businesses, well, pretty much the bonds are going to be in this range. How much interest we have to pay? Can we make 15% net of interest and so forth? That's how business decisions are done. Oh, let's build another factory.
Right. Can we make long term investments, which obviously spur jobs, which spur economic activity? Look, let's just be real here to the audience here. The years of 3 and 4% interest rates for your house is dead. It's not coming back anytime soon. It was a anomaly based on two major things: 2008, coupled with, I mean, essentially almost 6 or 7 years later, COVID. Right. I mean, we recovered by the time we recovered was 2013. Right. You know, so really that depressed low interest rate, or that, we'll call it artificially low interest rate, was built on two major catalysts: 2008 being the largest recession known to modern times, and then it took us, we'll call it 4 or 5 years to recover in 2013. By the time 2013, we were just kind of walking out of this thing. Then COVID happens, right? Then you got to cut them again, right? And that two and threes in that brief window from 2020 to 2022 ish is, never coming back. And I think people are starting to realize that now. They're going to go, biting the bullet. We're going to make this bigger house payment. We're going to do whatever we need to do to get what we want.
Right. Now you take that and you say, okay, if I'm an investor, 12 months ago, 16 months ago, you were making over 5% on your money market rates. You're making over 5%. We can put some money in cash, and cash levels have, well, this is a repeat because each year the cash levels keep going up no matter what happens. But we got a lot of cash out there, which is fuel that's coal for the fire. And if you get interest rates to the point where they get to be three something, I don't know. I wouldn't cross the street for 3% interest rate.
I mean, right now we're at 350s on the money markets, right?
Right. We could possibly see something in the high twos by the end of the year.
And it's not as exciting anymore, right? You go 350s. Now I go, man, I really probably want to do something different. I want to invest. I want to buy bonds. I want to buy corporate treasuries, corporate bonds, or maybe, go into the market somewhere. And
you just hit on something that is, we throw out all these terms and we talk about all these numbers and ratios and so forth, but it's not that complicated. If you really want to take the marketplace, think about that. It's a marketplace. It's not a lot of different than a farmer's market. You have people are selling goods, you have people are buying goods. And if the people start making more money, they're going to start buying more goods. And that's what's happening right now. And another thing, and people don't talk about this, but the amount of stocks in the stock market is decreasing very slightly, but it's decreasing. It's not getting bigger. So we're making the economy's very productive, but the companies are buying back their own stock. Yes, new companies are coming in, but there are not at the same ratio. So you don't have as much stock to buy. So what does, companies keep buying back more of their stock, which is happening all the time right now. And it's going to get even worse. And we're expecting mergers and acquisitions to pick up next year. So then the number of companies are going to disappear. So now you're talking about a money supply in the United States, which is slowly growing, but the number of stocks are going down. That's a 101 economics. That's price theory. That means prices will go up. It's common sense stuff. Don't try to overthink this.
I think the other thing that you kind of captured on there was fewer stocks. The ability for companies and private companies to raise funds is just so much easier. There's more access, there's more information, right? So, companies are staying private longer, right? Because they don't have to go public anymore, right? They can go get series funding and have a bigger audience, right?
Right.
I mean, alternative funds have become democratized per se, right? I mean, you think about even just 5 years ago, in some places there were $1 million limits, right? Those $1 million limits gone to 250,000, right? I remember structured notes when we first started doing a few structured notes here and there. There's $1 million limit to get a custom, right?
Yeah,
Now,
mortgage-backed securities. The securitization is
right,
really
right now
getting
they've
sophisticated.
gotten to $250,000 for custom notes, and I'm going, he's,
Yeah,
this
yeah,
was
or less.
this
Yeah,
is used to be for the uber wealthy, right?
yeah.
Yeah, you got tack on notes for $1,000, right? Um, you know, the democratization of investments has really kind of changed the landscape too, because no longer is it just kind of in this small circle, right? It's gotten to a bigger degree right now. There's got to be a trust factor from the called general public, right? Because the general public is now going, what is this new little thing you put out here, right? Even though the world has known about it for a long time.
This is probably a great time to bring in, because you can't have an economic forecast without talking about AI. So what you're talking about, you take these very complicated things that only the ultra rich could do 3 4 years ago, and now it's bringing it down. And now you throw an AI, and it's going to make it easy for the man on the street to start to make some very complicated decisions, and they'll figure it out.
Right.
Everything's going to become something. It sounds like a very confusing comment, but knowledge is going to become universal.
It is. And I tell people this all the time. AI has changed the business world forever. By what I mean by that is not to say you and me, but we'll pick on, two people, two accounts. At some point, now they're whether you're a 30-year accountant or a 3-year accountant, your knowledge level is about here, right? It's pretty close now. This used to be here, right? But with the democratization of information with AI, the gap has been closed, right? So really, at this point in the world, what you have left is expertise, how to apply it, soft skills, right? Those become we're actually reverting back to the 80s and 90s when handshakes were important and how you showed up to an interview and all those things because, you know, whether you knew accounting or you didn't know it, I mean, it's about the same now.
Yeah.
Right.
Yeah, boy, it's you want to talk about how sophisticated this is getting, and how they're bringing macro things down to the micro level. I had a client call me, and I don't know where this guy's getting his information, but he said, "John, I think China's going to invade Taiwan. It's going to be sooner than later. We need to adjust our portfolio because this is going to happen." And I said, "Bob, just Google, will China invade Taiwan?" And the answer that comes back is so terribly sophisticated that it's like these are the brains of the brains of the brains. The answer is so makes so much sense. And it goes into the fact that that's a little teaser, but no, they won't, because they've got that. We talked about this off screen, that the amount of population there is decreasing. China has this chip on their table that says we can invade Taiwan anytime possible. And they're going to use that for negotiation purposes for the next 20 years. This is something that they have that nobody else has. And so they can use it for negotiations, for threats, for policies, and so forth. But it'd be the worst possible thing, because if they did, first of all, it could be horrendous for their economy and trading partners. And China lives on trading partners. If they didn't have trading partners, they wouldn't have anything. So uh, if you take that chip off the table, because now they can't threaten anybody. Now what are you going to do? You know, so it would be terrible for them. It's a lose situation for China, but it's a great. It's sort of like what Trump said with Greenland. You know, you got to do it, or we'll just take it. That's negotiation ploy. From day one, everybody knew he wasn't going to invade Greenland, but a lot of people in the media thought so. And now, it's the art of the deal, folks. You start high, and then you work down to a level where everybody thinks they have a win-win situation when they walk out of the room. Same thing with China. China, oh, you have to do this or we're going to invade you. Well, let's talk about it. And we come to a deal. And China was never going to invade in the first place, but the other guys didn't know that. So they work out a deal. That's how this works in politics. But now you go to AI and you get that answer. Holy sugar pops.
Right. You know, you look through.
Clean that up for you.
Yeah, of course. Yeah. Yeah, I'm sure they don't mind, but hey, but you know, that's one of those things that people look at, and you know, emerging markets is, I think, right for a good opportunity this year. Like you said, we not touch other PEs are, you know, pretty depressed right now, right?
You know, when economies go back, the bigger economies happen first, and then it kind of filters down. Yeah, that's why the mid caps are starting to move, and small caps are showing some life. But and internationally, it's the example for the bigger economies move first, and then now the emerging markets. Emerging markets are very well priced right here. Their price earnings ratios are very low, and their earnings expectations are jumping up dramatically.
Right.
So emerging markets look real good this year. Financials look real good this year. Uh, yeah, I think the whole S&P 500 is going to look good. You had the Magnificent Seven and we call it the Impressive 493. In the last month, the Magnificent Seven are down like 12.7%, 12.3, something like that.
Right.
And the S&P 500 is going up. The people who did the AI, who made a lot of money in the last couple of years, now that is starting to get to a saturation state, but the benefits are moving over to the 493 and their profits are going to be going up this year.
Right.
So everything looks rather attractive. That's another factor why I think
Right.
market's going to do quite that.
You know, and I think bonds are still paying good money. I think that's always kind of here for now, right? I don't think they're going anywhere, and I like it, honestly. I actually, I tell people all the time, you still got to go seek your interest. I mean, banks have figured it out. They figured out that people are lazy. 0.01, they'll take it, and we're gonna keep the spread of 350 or whatever it is, right? Um, so there's lots of, I think there's still lots of, you know, interest to be earned there. Bonds, good place to be if you really want some good interest income. And again, some of that democratization of certain things like CLOs, right? I mean, you know, that's, you and I talked about the, you know, AAA rated CLOs, you know, I think it's essentially zero default rates.
Yeah, and they're still paying an attractive rate of interest too. So there are things to do in the bond market, which so to bring this down to the man on the street, then you have to see, well, okay, where do I invest, man, for 2026? And then after you figure out what the risk level is and the liquidity needs and so forth, to make this very simple for the man on the street is that you have a certain portfolio design, and we to make this very very simple, we say the first number is stocks and the second number is bonds. So if you're real aggressive and you're 27 and doing quite well, or not even doing quite well, you're 27, is you should probably be 100% in equities. Well, I don't know why you'd be in bonds at that point, because
Right.
you can take the risk. But for the man on the street, I don't know, I kind of think a 70-30. I'm just kind of shooting from the hip there. Might be an attractive year this year for them.
You know, there's some good opportunities there. You know, reduce the volatility because I'm going to tell you, there's going to be a volatile year though. I do believe there's going to be some volatility.
I've been doing this 48 years. There's always volatility. There's always, the known, the known unknown. Right now, or the unknown unknown is and there'll be something. There'll be several somethings.
Yeah.
And we talk about that too. In the average 10-year time period, you're going to have 7 up years, 2 down years, and 1 sideways. And usually those 2 down years, you have no idea that it's going to happen. And it comes out of nowhere. Credit default swaps exploding. I defy anybody that says, I really knew that was going to happen. You're either a liar or you're stupid, because that nobody knew that except for a handful of people, and they wrote a book about it.
Right.
And some of those people that saw that have been predicting things ever since 2008, and their batting averages aren't very good. They were right once. Okay, they swung at a fastball, hit a home run, and they've been striking out a lot since then. So, smart people, but that doesn't make them invincible.
So I'll switch a little bit of a gear here to behavioral finance stuff, which is the 4% rule. It's been gnawing at me, especially where interest rates are at. And I've kind of brushed about 4% rule is dead. And you've been doing this 48 years. So you've seen people retire fully through, right? And pass, right? Uh, is the 4% rule dead?
I wrote a paper on this, man. I don't know if you know that or not, but it was called the 4% fallacy. And to give you just a little background, where I could go on for hours with this.
We'll nutshell it. We'll AI say AI. Give me something.
Let me give you the bottom line. If you took $1 million and you go back as far as you can go, and that actually just is 1975. Why 1975? Well, believe it or not, that's when the bond index started with Lehman Brothers bond index. There was no Lehman Brothers bond index in 1974. So it started 75. So if you're going to build a portfolio where you're going to say, well, we're going to put money in stocks and we're going to put money in bonds, that's when the first year where it was tracked. You go back to 1975, you put in $1 million in a portfolio, in a 60-40 portfolio. So 60% stocks, 40% bonds. You're not managing it. You're not market timing it. You just throw it in there, let it sit and see what it does. If you did that 1975 and took out 9% per year since then, not a dollar amount, a percentage amount. So if it goes up, you take out more. You goes down, you take out less. You would have taken out over $4 million out of that portfolio, and you'd still have more than $1 million. You didn't run out of money. And people will tell you can't take out more than four, you're gonna run out of money. And here is the secret. And this is what they don't tell you. Nobody tells you this. I'm not even sure Min knows this, but when they take out, they say, let's say 5%. They say, well, you want to adjust it for inflation, don't you? And the man on the street or the advisor go, yeah, well, that makes sense. We should adjust it for inflation. So what they do, dirty little secret. So you take out 5% the first year, and then they adjust it for inflation. Next year, they take out 3% inflation, let's say. So they take that's 5.15 the next year. And then it goes to 5.3 or 5.31 because you get a multiplying factor, and then it goes up more. And then before you know it, you're at 6. When you're in your 10th year, you're close to taking out a double digits. Okay. I mean, this is just do the math on this, run it yourself. And you get into the 15th year, and now you're definitely taking out 10, you're probably taking out 12. Now you're taking out more than you should be taking out because you're adjusting it for inflation. Da, da, da. This is like the same thing. Do you want $1 million or do you want a penny that doubles every day for a month? Well, it doubles in probably around the 27th day, or it gets to $1 million, 27th day. And then it keeps going up from there. So you're on. Here's the bottom line. Here's the sex appeal line. You run out of money due to mathematics, not due to the market situation. So if you just take out the same percent every year and not adjust for inflation, it will take care of itself. If you want to do the math, at a 60-40 portfolio, and I'm going to throw these at you real quick. You can write them down, but if you take out 6% over the last, since 1975, just the S&P 500 is averaged 11%. If you do the math, what is 60% of 11? 6.6. Put 6.6 down. Then if you turn around and take the bonds and of 40% portfolio, and believe it or not, over the last 45 years, the bond market has averaged 6%. 40% of 6 or 6% of 4, you get 2.4. 6.6, 2.4 comes to 9. Right. That's where you get the number. And another important thing is that you put that money to the side before you. So you should have already have your 2000. You sold things when they were up in 2025. You take that money, you put it in cash, and that's going to be your withdrawal money for 2026. And if the market does the same thing in 2026, you start taking out for 2027. If you're wrong and the market goes down, you don't have to sell stuff that's down. You've already got it in cash. And you know how bear markets, they usually last 6 to 9 months. And then you don't have to sell stuff when the market goes down. If you didn't do that in 2008, you're screwed. Okay. Because people did that and they sold when the market was at the low, and now they're a greater at Walmart. So you have the point of view.
No, I always
Hope everybody's still awake.
when you are a young financial advisor, you're taught these kind of rules to kind of help you navigate the world, right? When you're talking clients and consulting clients, right? But then it isn't until you get some experience in working with clients who have truly retired, right? You probably don't hit that mark until maybe when you're, depends on what firm you're at, right? But if you started out where we're at, like scrappy little firms where they go, here's a job and business card, and you go figure it out, little guy. You probably won't get to that mark until you're in year 10, right?
Yeah.
Right.
Probably true comment.
Right. You won't get there till year 10. So then you got to go, okay, now I got to see how it works for the next 5 or 7 years to see the real experience of people taking out 4%. And somehow they are taking out 4%. And then next year, the next year, the next year, the next year, and then you go, man, look, Johnny retired 7 years ago with $1 million. He's actually got $1.4 million, right? And we go, gosh, why am I only taking out 4, right? And I tell my clients all the time, even to my own detriment, right? Spend it all. I mean, I want you to figure out how to get the last check to bounce, right? Your kids don't need it. We don't need it. To my own financial detriment, right? Based on our fees, I still would tell you to spend it, enjoy your money that you worked so hard for. So when you think about the 4% rule, sometimes it's just an interesting conversation. I love your thought process of telling people don't sell at the bottom. The other part of selling at the bottom, the challenge there is, well, how do you? There's what you intellectually know, which is don't sell at the bottom.
Yeah,
that is what you emotionally know. Which is
emotionally, that's your heart or your head. What are you going to think with?
Right. So I really got to this place where I'm playing with clients and go, hey, let's just build a 3-year buffer. Maybe 5-year, maybe 7 if you're really conservative. But if we get a 5-year buffer and we go, okay, put 5-year into non-correlated assets that are not rolling with the market, right? Maybe they're bonds, maybe it's cash, maybe it's a combination of bonds and cash and T-bills and alternatives and whatever you can think of, right? That don't ride with the stock market. And then you go, look, John, I know the market's down 38% like it was in '08, but look, we got 7 years worth of bills sitting right here, and it hasn't really. It's little, but it hasn't. It hasn't taken the nosedive. We're gonna be okay. Let's just live on to the next 7 years, and even the worst of the worst times, we made it. Right.
Exactly right. Yeah. I mean, when I was young, I figured out that it was, gee, back when interest rates are higher, I said, you could retire and you take your portfolio and you put 85% of it in 30-year bonds. And let's say you're going to get 6.5%, 7%. You probably get 7, 8% if you want to, maybe single A bonds, so forth, are still safe. And then take the remaining 15% and put that in equities. And you live off the income that you're making the bonds. And then when the markets go up 10%, you sell back that 10% in the bond and stocks, and you buy more bonds. So you have fixed income that adjusted for like inflation, and it comes from your equity portfolio. And the equity portfolio didn't go away. You just took off the gains, put them back into the bond market, and you got a guaranteed rate of income that there has practically no risk. Your risk would come since you're buying 20 and 30-year bonds. That should be okay, but when interest rates go to zero, basically you're building a portfolio that looks like an insurance company,
Right.
And so you can pay out a certain rate forever. But it can get a little weird. But usually when that happens, when interest rates come down, your bond portfolio goes up. So it's 6, 1/2 dozen the other.
And there's so much, the financial world is so eager to put you in a vacuum, right? But ultimately, finance is not a vacuum, right? I mean, there's ebbs and flows, right? I mean, your first 10 years of your retirement, you probably spent a lot of money. Maybe the first 15. Back 10 or 15, you're probably not spending as much, right? Right. And they go, well, it's going to be inflation just forever. But, you're not taking a cruise at 87. You might, but you might take one, not 4. You might, right? Because you like cruises, right? But you're not taking 4 or 5 in your early 60s like you did when you retired in your mid 60s, late 60s, when you taking maybe one when you're 87.
We refer to that as when you retire, it's your go-go years, and then you get into the late 70s, early 80s, it's slow-go years, and then after that, it's the no-go years.
I'm going to use that actually.
Yeah, that's one of my favorites.
And so I think when people start thinking about this plan for retirement, it's evolved so much, and the industry has evolved so much that some of these old school rules of thumb still work, obviously, but some of them are a little outdated. And you're right, the 4% rule, yes, the inflation adjustment, and then they take the worst starting point in terms of sequence of returns and go, this is what you're back testing for. Well, a lot of those are anomalies,
Right.
too, right?
Yeah, that's correct.
Like in 2000, you go, okay, well, we're gonna start. Sure, okay, worst case, you start in 2008. I get it, right? But you got to plan for these anomalies, and they're not always going to happen. And you adjust on the fly as an advisor. You're not sitting there on 2008 going, oh man, we're down 38%. Let's just keep going.
Oh yeah, oh yeah, and the markets have a way of correcting themselves. But at the time, I know so many people that still invest because, like the 2008, put scar tissue on their brain and on their heart. They are never going to change.
Right.
Well, they they're starting to change, and when those people start going into the market, now that's the time we will be peering back.
And people's
They're like a bellwether,
people
like a
take
bell cow, man.
people take so long to adjust to these. 2022 is a blip. Negative 18% in the S&P was a blip. But I bet you there's still people today that are, especially if they're older, in their 60s or in their late 50s, that go, oh, remember what happened in 2022, down, whatever, right? And then
Hey,
now they're getting out of cash.
what happened last year?
Right.
What happened in March and April? Everybody talks about the year. Oh, the year was up, 18%. We were down 19% in early April. People forget that. We got that 19%. They were worried about tariffs of all things.
Tariffs.
The unknown. They're worried about tariffs. I won't go into that, but we were never worried about tariffs. The media, and that's one thing in our business. There's some smart people to listen to. The media has no idea who these people are, but we never worried about tariffs.
Oh, you're going to fire me up on this media. I can't stand the media people. My gosh. Paid entertainers to talk about just the silliest stuff in the world that doesn't have anything to do, and they have no risk. Zero risk.
Yeah. We can go on this route. But one of the good things about our business is that we're talking about being in the business for a duration, a long time.
Right.
We tend to find the right people to listen to. And because nobody knows everything about everything.
No.
But there are, and I won't mention any names, but there are some people that I listen to religiously, and there's multiple of them. There's just not one or two, but I've got a handful that everything they write or bring out or talk about, I listen to, and I steal all those ideas. I put them together, and you come up with your own opinion. It's not original knowledge or anything, but it's you got to take away the noise,
Right.
and listen to the facts and understand and know how to project it, and it takes a dozen years in the business before you can even start to think of that.
By the way, this is year 20. I don't know if you know.
20?
20.
Really?
Yes.
Oh my God. I remember when you started.
This is year 20. Yeah. I actually, 2006 is my first original license date.
Congratulations.
So this is year 20. So with that experience, as you get older, you start to think, and you start to question a little bit of some of the original, and I understand why you were taught those things, because they're the guardrails so that you don't make poor recommendations when you're fresh out, still smell like breast, right?
Right.
But and then some of that has to evolve with the times too, right? Again, it's accessibility, right? Did you know what a AAA CLO was 20 years ago? How would you have to find that information? You'd have to really dig and research and really get in there, right? And where are the CLOs, and who's selling them, and who's got them, and today,
what is the risk? And and you may have a lot of investors have a lot of stuff they don't know what they have,
right?
And if it goes bad, they go like, why'd they go bad? And you don't want to be in that position as an advisor,
right? And I'm only saying that we're I'm not pushing the lows or anything. I'm just using that as a very
That's a good example.
nuanced, non-mainstream investments in the world, right? So I only use that as so I'm not pushing it, just so y'all know. Compliance is the same. But anyways, I think we've had some fun conversations here. 2022 is coming upon 2022. 2026 is upon us here.
19. Oh, wait a minute. We're on 19.
I tell people when I'm at the gym, if you're born in the 1900s, you got to stretch.
Sure.
Non-negotiable. Non-negotiable at that point, right?
Oh, yeah.
So, anyways,
Well, it's going to have a good year. I think we're going to have a good year. Hopefully, knock on wood. But it looks a lot like last year. We'll have those surprises like that we just talked about. There'll be another tariff thing's going to happen. The average correction per year, the average over the last 50 years is 13.4. And you knew that. So you should have a correction. And you'll probably have three corrections of 5 to 7%, maybe 1 to 10%. And maybe every 7 to 8 years you get the big ones that you don't like to talk about. But I mean, last year 19%, and we came back when we closed positive. What happens if we don't have that 19% correction? Okay, because we got the 19% back and had another 18, so you stop and take the bottom. You're up 36% from the bottom. Now, what if we don't have that sell off and the market just keeps going up? Could be a good year. We'll see.
Or, if you are lucky enough to diversify yourself, remove some of the volatility, right? Because there is some ways to remove volatility, right? Whether it's defensive, whether and maybe you give up some returns, but you're comfortable with that, right? Everyone's got a comfort level on the ride, right? Some people drive Lincolns because they have great ride. I remember the old guys. Everybody drives a Lincoln Town Car. I remember, especially when you were younger. When I was younger, we drove a Lincoln Town Car because Lincoln Town Car was smooth, right? You just you love the smooth ride. Some people like that. Some people don't mind the 26-inch lifted truck on paper thin wheels, and they feel every bump. That's okay too.
Whatever turns you on.
Everybody's got a preference. You just got to help somebody figure out that preference for you. Me, John, whoever it is that you find it.
Everybody's different.
All right. Thank you, John. I appreciate you.
Thanks, man.
All right.